I want to welcome everybody who's on the webinar today for our webinar on rethinking your enterprise risk management strategies to reduce those 6 to 7 figure insurance premiums. My name is Mike Moffett. I'm the president of Cornerstone Financial Group, a company that I founded back in the late 80s. And just wanted to give you a little bit of an update on us. Cornerstone Financial Group, if I can get my mouse to help me out.
Yeah.
There we go. As I said, company founded in 1987. We started out working with a lot of individuals. Through the years, we've kind of transitioned into working more with businesses. And this webinar series is part of what we call our best webinar series, business enhancement strategies and tools. What we found through the years is that it's my belief that education is the key to becoming successful when it comes to finances, financial strategies, business success. And we've kind of taken that into what we do with business owners as well in starting this webinar series, in keeping with our helping wealth creators grow and preserve their legacy. So there's a lot of external factors that affect businesses these days, and we can have varying levels of control over these. Regulations, not something you're more reacting than actually having control of them. Shrinking margins, taxes, that was one of our last webinars. The differences between the tax aspects of the two candidates for president. The trend towards online business for a lot of folks, especially in the era of COVID. And then obviously one of the things that we're going to touch on today is rising insurance costs. I was talking a couple of days ago with a client of mine who works at an insurance brokerage firm, a rather large one, and he was saying that some coverages he was working with, for some clients, he saw increases of over 400% in the last year in some of those coverages. So obviously it's something that you have to keep an eye on. And as far as part of this education on the insurance side, we've put together what we call a virtual family office, understanding that we can't be all things to all people. And also understanding that a lot of business owners need help in specific areas. We've kind of put together this concept of bringing those experts to you if you don't have your own experts in those areas, kind of like you would with a family office for the ultra wealthy. We've kind of brought it down to the level of more folks who can benefit from it. This is just a partial list that you see here on the screen of folks that we have on our team, our virtual team, that can help you if you have any questions in these areas. And obviously today we've highlighted the one that's front and center, risk and insurance specialists. And I think actually some of these folks are regional folks, some of them are more national folks. Today we have what I would consider one of the best national resources in this area, and his name is Wesley Sirk. Wes is president and co-founder of Risk Management Advisors, Inc. He hasn't been in business quite as long as I have, but he's not too far behind. He has over 25 years of experience in this industry. Ensures due diligence, compliance, and proper implementation of all plan designs that he works with. He's an author. He's had a couple of books on captive insurance, which I've listed here. Frequently speaks at insurance and accounting associations, although probably remotely these days. And has also been featured in some writings in Business Insurance, National Underwriter, Los Angeles Times, and more. A couple of things I want to mention before we get started. This is a listen-only mode for this webinar. So what that means is you won't be able to actually contribute anything other than you can ask questions using the chat feature, which you should have on your controls. So if you want to ask a question, go ahead and ask it through the chat, direct it to the presenters, the panelists, and we'll try to sneak those in as we can. So I think with that, I will turn it over to you, Wes.
All right, perfect. Well, thank you. I wish I could move it from one. My camera looks at this screen and all the information's on this. So I should have thought of that ahead of time. But so I'm going to be going back and forth between the camera and the and the screen. What my goal is, let's see if this works. And we tested it out and it did.
There you go.
Ah, there it is. Perfect. So what my goal is today, we're talking about captive insurance companies. And the goal would be for you to understand at the end of this, what is a captive insurance company, how you can use it. And then I always find I learn best through case studies. So we're going to be going through.
Sorry, I did that.
No, it's fine. Going through some case studies of how other clients have used it. Hold on. There we go. So our clients are looking for ways to, one, control the cost of insurance. This pandemic has been bad for a lot of people, but especially for insurance companies. It's almost like the perfect storm. If you look at Hurricane Katrina, was the largest single insurable event in U.S. history. And this COVID is the equivalent of 3 Katrinas a month for 5 months, as far as the cost that the insurance companies are having. And hopefully we'll have some time to get into why and how it is. But as Mike was mentioning, we have a client in Texas whose property insurance on their portfolio has gone from 2.4 to $6.2 million from last year to this year renewal in July. So a lot of people are facing a lot of increases. So they want to control the cost of their insurance. It eats into the bottom line. They want to improve claims handling. You know, how do they, a lot of business owners they shake their head and thinking, why do the insurance companies settle on this, but not settle on this? So they want more control over who gets paid, when they get paid, and how much they get paid. Improving the cash flow. As you can imagine, when your insurance premium, doubles or triples, that eats into the cash flow of the business. And then they want to design coverage that helps their business. Because a lot of times, a lot of the insurance products you're getting are kind of off the shelf, and it aren't specifically tailored to your individual business. So what is a captive? It's very simple. It's an insurance company that a business owner sets up to insure their business, any of their employees, or any businesses they have control over. So it's a licensed, regulated insurance company, but it has a special purpose license. So you're only able to cover your own businesses. So you can't go out and sell to the general public, but you can sell to your own individual businesses. A common structure that we see, if you think of the business owner, so the people on the call, you're a business owner. You own the business. Well, you set up your own insurance company, and then you pay premiums from your own insurance company, from your own business over to your own insurance company. And the insurance company issues policies back to that individual business. But because you're the shareholder of the captive insurance company, you get the benefits of all that underwriting profit that would have been going to the traditional insurance companies, now stays with you. To just use some round numbers, insurance, workers' comp insurance. And the way I got into captives is I used to sell insurance. And then I realized the insurance companies always had more money than I did. So what I did is my partner Jared and I, we said, how do we become our own insurance company? So we did the research, we figured it out. And then at that point, we started with workers' comp. Workers' comp is a 50% margin business. So if we charge somebody $1 million in premium, we expected to pay out $500,000 for that year over a period of time. Now, if we came back and said, well, you know what? Good news, you didn't have any claims, but everyone else in your industry did, so we have to raise your premium a little bit. Or we got to say, you know what? You had bad claims, so we expect to pay out $800,000 instead of the $500,000. So what happens is we got to raise their experience mod, so we collected an extra $100,000 a year each year over a 3-year period of time. Doesn't matter what we actually paid, just because we expected to pay it, we got to increase the premium. So what you're doing is you're paying premiums deductibly from your business to your own captive insurance company. And then all that underwriting profit you get to keep yourself. There's two types. You know, in the back of your mind, you may be thinking, well, why would I want my own insurance company? We're going to get into that right now. Two different types. There's what's called an 831A, and that's all insurance companies. Think of the large ones: AIG, Zurich, Liberty. They're taxed. An insurance company, a traditional insurance company, Berkshire Hathaway, they take in premium dollars as taxable income, but they get a deduction for any claims they have, any expenses they have, anything that the actuaries say they need to keep in reserves. And then there's this gray area called incurred but not reported. So that's the insurance company's way of saying, well, we have claims, we just don't know when they're going to get to us. They have investment returns. So think of a large insurance company, an AIG. You know, they take in $1 billion in premium and they have $200 billion in claims, well, or $200 million in claims. So that leaves $800 million. But what happens is they say, well, we have expenses of this, we pay commissions of this, but anything left over, they say they need to keep that in reserves. So that's how the insurance companies are able to basically kick that tax can down the road. As long as they can say they need to keep money in reserves to pay claims, then it's not taxable to them. When it gets released, at that point, they have to reclaim that as taxable income. So the whole game with insurance, and we played the game, owning an insurance company, is we release reserves when we had other claims that came in that we could say, oh, we're releasing this $1 million, but we have another claim that could be $1 million. So now we get to put that away and just keep moving that down the road. And it's over there on my shelf, but it's a book written in the early 80s. I think it's 1980 by Andrew Tobias. I may be the only one old enough to remember. Maybe Mike remembers Andrew Tobias from the early 80s. But he wrote a book called The Invisible Bankers. And it's all about the tax treatment and how insurance companies, and this was back in 1980, have become the invisible banks in our economy. So, you know, fast forward 2008, there was that whole too big to fail with AIG. And it's kind of the same thing. They've been given special breaks through Congress and accumulate dollars. Anything left over, once they release it, they have to pay corporate income taxes. Now, a lot of our clients, they form their own insurance company, and this is the 831B. And you're an insurance company, but it's a special tax benefit. So if you're an 831B, you're limited to $2.3 million a year in annual premium, but all of your underwriting profit is tax-free. All your reserves that gets released are tax-free. Those insurance companies, an 831B, only pays taxes on its realized investment earnings. Let me say that again. An 831B insurance company only pays tax on its realized investment earnings. So we have clients, let's say you pay $2 million a year for a 5-year period of time. So you have $10 million in your insurance company, but you only had $1 million in claims because you ran your business better than your peers. Well, at that point, that $9 million is inside your insurance company and it has not been taxed. You've only been taxed on your realized investment earnings.
So a quick question there, Wes. If, let's say you're spending $3 or $4 million a year right now on various coverages, would that preclude you from setting up an 831B, or can you just still do that? You could only run the 2.3 million through it.
Yeah, well, we have clients that pay more than that, and let's say it's 2 owners of the business. Each owner can set up their own 831B where they both take 50% of the risk, basically in a quota share. So we've done that. We have other clients that set up the 831B, and let's say their premiums were $2 million, but their business keeps growing.
Sure.
Then all we do is we increase the deductible. So when you're captive, it may be that they're taking the first $1,000 of every claim stays with the business. But as if they wanted to keep under the 831B limit, then what we do is we raise that from 1,000 to 5,000 to 10,000. So there are ways to do it. And we also have a lot of these captives, if you're doing health insurance, workers' comp, general liability, commercial property, you don't want to go naked on that. So you end up going and buying reinsurance for that. So it's really the captive takes one piece and the reinsurer takes the rest. And there's certainly ways to keep it under that limit.
So you could structure it so that the reinsurance takes anything over the 2.3.
Well, not so. Let's say that their premiums are $4 million. Then their captive takes a certain amount of risk. Let's say their captive takes the first $250,000 every claim up to $2.5 million total, because there has to be a difference, a delta between the premiums and what their total risk is. But then the reinsurers step in for anything above 250 and anything over that 2.5, and that premium may be, let's say that premium's $1 million. So what you've done is you've actually, the captive is taking the $2.3 million, and then you're paying directly to the reinsurers for the reinsurance costs. So every business has risk. Now, the white colored is the things that normally the business owners have insurance for. So there's health insurance, E&O, excess, general liability. There may be, crop insurance if you're a farmer. It's all over the board. But there's also things that the business owner has not bought insurance for, usually, or it's excluded from their policy. Now, if you remember the old days of insurance, what happened was, the policies were 25 pages and 2 of those were exclusions. Now the policies are 5 pages, but it's 25 pages of what's excluded from the policy. So there's a lot of exclusions in the policies nowadays. And, there's specific reasons for it, which get into really the art and science of insurance. But the insurance industry did itself a big disservice in the early 90s by commoditizing their product. So they went to, if you look at the bottom of your insurance forms, it'll say insurance service office or ISO form like CG 00001 for commercial general liability. So instead of all the insurance companies creating their own policies, what they did is they all agreed to fund this one group called the ISO, the Insurance Service Office, and their job is to write policies. So that's all they do. So if they're funded by all the insurance companies and now they write the standard policy that most insurance companies use, whose favor do you think they write the policy in? The business owner or the insurance company that pays their bills? It's kind of rhetorical, but the policies are now benefiting the insurance companies, not the policyholders. That's why you see. But then most insurance companies are trying to get out of paying COVID-related claims, versus a captive where we've been covering viral and bacterial events for our clients since 2015 and 16. So there's, right now we're processing $19 million was the last number I saw in our captive clients submitting business interruption COVID-related claims to their own insurance company. And so we're using it exactly the way it's meant. They put away money in times for good so they can pull money out and submit claims when times are bad. So if we look at the red, there's a lot of things that are excluded. Deductibles, mold is a big one, construction defect, earthquake in states like California. There's a lot of businesses. I would say, anecdotally, probably 70% of the businesses that we meet with don't have earthquake insurance, and they may have large commercial property portfolios, and the cost is so prohibitive, and the amount of deductible that they have to take or self-insured retention is so high. They're like, well, why would I do this? If the cost to rebuild my building is $1 million, but I have to pay $300 in earthquake insurance and I have a $250 deductible, where's the win for me in that? I would rather put the money in, just save it in my business for 3 or 4 years and I'd have enough to cover that. But that's what insurance is for. So now they can buy that insurance from their own insurance company and cover that. So, I get, if these things are so good, why aren't they widely used? And I'd say there are, because over 50% of the commercial property casualty marketplace globally is in a captive or risk retention in one way, shape, or form. Virtually all Fortune 500 companies have 1, 2, or 3 captives. Most energies, utilities, hospitals, they all have them. I would put down universities. My 2 partners sit on the board of Fiat Lux, which is the University of California's captive insurance company. And now I believe they have 3 covering the University of California, all their campuses. But they do from medical malpractice to renters insurance for the people who are on in the student housing. So you're talking a $350 to $400 million premium enterprise with a claims ratio that is about 30%. So it's much more cost effective for them to create their own captive and keep that risk in their own business.
Might be off topic just a little bit, but you mentioned the renter's insurance, and I was thinking that this is something that probably could be used for folks that have a lot of real estate property, right? How do they market that renter's insurance? If I was a renter, why would I not just go to State Farm and get it or something like that, as opposed to getting it through the captive of the company that owns the property?
Yeah, great question. We, with our clients, one we just finished up with the renewing of the renter's insurance, they have 6,000 doors. So they have 6,000 apartment units. When they're renting, they say, we're requiring you to have renter's insurance. Now, you can go and get it from your State Farm or your Farmers, or we offer coverage, from XYZ insurance company. Would you like to buy that? And most of the time they do it, it's a counter sale, meaning it's when they're signing the lease, and it's easier. You cannot do what's called forced placed insurance. You can't say, we will only rent to you if you buy our insurance. But if you give people the option to say, okay, you need renter's insurance if you want to live here, and you can go get it, but here's another solution. I would say it's probably not more than 9 times out of 10. If the people don't already have the insurance, they'll just do it. They'll do it while they're there.
I'm guessing that's a pretty high profit margin on that.
Yeah, I mean, our claims ratio on renter's insurance is anywhere between 2 on the low end and 7 on the high end. So it's not 7% of premium. So it's a very profitable line of premium. And it's something that they get charged every single month. It just gets added to their rent. So let's say the rent was $1,200 and the renter's insurance is $12. Then the invoice they get for their rent is $1,212. And then the renter's insurance is line itemed out. So when they get the check in on their books, they just move it to say, oh, this is for premium, and they put it in their insurance company, so they get to deduct it from their income. So now it's just a portion of their income that's tax deductible. Okay. So what does the IRS say about this? More than 50% of the business of a captive has to be issuing insurance, because it has some tax benefits to it. Some people put money in and then they don't write insurance anymore. So, that's something you need to do. It needs to be a bona fide insurance company that's legitimate. It has to look, act, and smell like an insurance company. It has to have a business purpose. You can't be writing, let's say you're in Iowa, floods, tornadoes, that's great. Earthquakes, you may have earthquakes, but if suddenly you're writing, because the limit is $2.3 million, if suddenly you're writing $2 million in earthquake insurance, when you can buy that for $3,000 in the traditional market, well, the IRS would have a problem with that. So it's got to be legitimate. You have to have risk transfer, risk distribution. That gets into the technical side of it. Like I said, premiums have to be reasonable, and it has to operate as an insurance company. And that's what we do. All we do, we don't sell product. We don't sell insurance. We just manage insurance companies. We're like a third-party administrator. But there's a lot of stuff that goes into it. I mean, insurance companies, there's rules and regulations. They have to use what's mark-to-market accounting on a monthly basis. So even though if your investments have fallen, the Department of Insurance wants those financial statements every month that we have to run and give them to say you're satisfying all 10 of these ratios that they give us. All right, let's embrace the elephant in the room. As you can probably understand, if a business can deduct money from their business into an entity that does not pay taxes, there's room for abuse. So the IRS, starting in 2014 and 15, what they did is they came out and they started auditing certain captive insurance transactions. There were 3 main tax court cases that have come out. They've heard 5 cases in total, and 3 verdicts have come out. Now, right now in tax court, there are over 1,200 cases filed from this first round of audits, where they went after 6 captive managers as the promoter of a tax shelter. And they were doing what I was referring to earlier, which is, they were writing earthquake insurance to Iowa for $2 million. They're writing, let's say, a husband and wife own a business. Let's use the Abrahamis versus the commissioner case. Husband and wife own a business, a jewelry store in Scottsdale, Arizona. Very few employees, but they're writing, a couple $100,000 in employment practices liability insurance, a policy they could buy much cheaper in the traditional market. They wrote terrorism insurance, spent a couple $100,000 on that. They went as far as writing an IRS litigation defense policy, and they paid $300,000 in premium for that. So it said, in the event that they were audited and their captive was not proven to be an insurance company, that the insurance policy would cover the penalties, interest, and taxes for the business. So in tax court, the IRS said, if you thought this was legitimate at all, why would you have to spend $300,000 a year buying insurance for it? So it's kind of, their argument was dead from the word go. What makes it even worse, and this is a big not to do list item, is they put the money in the insurance company. They waited about 2 weeks and they loaned all that money out of the business, out of the insurance company back to the business so they could buy more jewelry. So what they had in essence was tax deductible working capital, and the IRS does not like that. So one main rule, and this goes back to a tax court ruling in the late 90s, that says if you loan money from your captive back to the entity that took the deduction, then they don't deem that to be an insurance company. Think about AIG. You pay $1 million in workers' comp to AIG. Can you imagine a scenario where AIG loans you back 90% of your premium for you to use in your business? It just would never happen. So in tax court, they listed a couple problem areas. a captive that insures esoteric or implausible risk, getting back to that, $2 million for earthquake insurance now in Iowa. But let's say that you had, $40,000 in earthquake insurance. That may be reasonable. But it has to be something that'll happen. If you're charging $1 million a year for insurance, the analogy I always like to use is, because we have the 405 freeway, which I can see, if you're writing $1 million in premium for auto insurance that only covers you going south on a freeway between 2 and 4 on a Sunday afternoon, then the chance of that risk happening is so small, but your premiums are so large. So the IRS is they have a very good team of people. So everything has to be legitimate. They have to cover business risk versus insurance risk. This is where the IRS has said repeatedly that there are certain things in business that are insurable and certain things that are not insurable. If it's something that could happen in the normal course of business, they consider that a business risk. People were writing this loss of a key client. The IRS says that's a risk in business. You have the risk of losing a client. That may not be a fortuitous event. So insurance risk covers specific things that's caused by a third party. So think of COVID. You have a business loss because something came in from the outside. Not, this is something where you control it. It's just a normal business relationship. Covers it doesn't match the need or risk of the insured. If you're writing policies that your business doesn't need, let's say terrorism, if your business doesn't have terrorism risk, then why are you spending all of this money on terrorism? Is a jewelry store with $5 million in revenue really a target of a terrorist attack that they need this premium? One of the tax court cases, the guy was writing, they were for a group of orthopedic surgeons in Boston, and they wrote a huge terrorism policy. And their argument in tax court was, well, we need it because what if a dirty bomb goes off and they can never work again in their facility? And the judge was like, what are you talking about? This is completely ridiculous. If they didn't own the insurance company and AIG gave them a quote for $400,000 a year for terrorism insurance, if they didn't own the insurance company and there was no tax benefit of it, would they have ever purchased that policy in the outside marketplace? And the answer, when they asked him under oath, they said no, they wouldn't have done it. So they killed themselves in that whole thing. One big thing that was noted in tax court is you have traditional insurance, you have insurance in the traditional marketplace, and you also buy it from your captive insurance company. Exorbitant premiums, we hit on that. An annual premium amount targeted to the amount of deduction needed. This is the key. The limit currently is $2.3 million in annual premium. That could go up next year. So stepping back, we spend a lot of time, with elected officials and trying to steer legislative stuff. So what happened was in 2015, the IRS went to Congress and said, we don't like captives. We think they're being abused. Now, before this, remember, this is when all these IRS audits started. What happened was, think of a wealthy family. Patriarch, matriarch own the business. They have a bunch of kids. They don't need any money. So what happened was they were having the captives owned by their children. At the time, the limit, the 831B limit, was 1.2 million in annual premium. So what happened is they were passing $1.2 million a year past the estate and gift tax line. So that's where they went to Congress, and my partner Jared actually sat on the, was an advisor to the subcommittee, and they had some strong arguments, but not only did Congress not get rid of captives, but they raised it from $1.2 million to $2.2 million, virtually doubling it. But now, remember, if you remember that first slide where I did the overview of the captive and the business have to be owned by the same people with regard to spouses and lineal descendants. So basically, husbands and wives have to, they have to own the business together. They can't one owns the business and one owns the captive as separate property. And they can't have it owned by their kids to pass the estate and gift tax line.
Now, Wes, you did mention, though, when we were conversing the other day about some strategies you can use with ascendants.
Mm-hmm.
Correct?
Yeah. And that's where, yeah, I mean, you and I have a good friend that has his captive and it's owned by his father. Because if you think of estate taxes, what the IRS does not like is they don't like you putting the assets down a generation, but you can move it up a generation. So his captive is actually owned by his parents. And then when he dies, it can pass to the next generation. At that point, they'll stop the captive, they'll set up a new one where the two of them end it. And because they're own it, because they're under the estate tax limits, then of having an issue, then they can pass that without estate taxes. And at death, you get a full step up in basis currently on those assets. So what you have is, let's say that there's $10 million when the parents die, $10 million, full step up in basis. They can pass it to the next basically to their grandkids, and you're escaping the estate and gift taxes on that.
So now, do you get into that much when we go through feasibility studies as far as strategies like that when building a captive? And how to
yeah, it's when we do with a captive, it's always begin with the end in mind. What's your business? What do you see as a likely transition? How do you see this going? How long do you foresee owning it and the business and, children, all of that. So yeah, that's all part of the discussion that we get into with clients. But this got back, it was a long-winded way of saying the annual premium targeted to the amount. But in these audits, what you see, and these were before they changed the limits, you would see a lot of $1.2 million. The annual premium is $1.2 million. The annual premium is 1.195. So they're basically targeting all their coverages to stay under the 831B limit. And that's where the IRS saw a lot of issues. And the ones they first targeted were a lot of the offshore ones. So you have your tax return, and it's an offshore insurance company being taxed as a U.S. taxpayer, so they're taking a 953D election. So it was very easy. Where they started these audits is give me all 953D insurance companies that are taking the 831B election that have a premium of $1.1 to $1.2 million. And those were the first round that they went after, because those were the ones where it was clear that they were targeting premiums, and this was more of a tax strategy than actually risk management. But tax court said there were good things. They said repeatedly, not all captives are bad. There are valid reasons to have a captive. During COVID, it's been perfect. The Wall Street Journal wrote an article a few months ago that said, because of COVID, this may be the death of the IRS audits on captives, because so many of them are using them to pay COVID-related claims and business interruption claims. As long as it has a bona fide purpose, operates as an insurance company, has reasonable premiums, you're fine. So who does this work for? Our clients, so we have well over 200 captives that we manage. I'd say the majority of them are onshore. We may have 5 to 10 that are offshore. But they go offshore because there's a specific reason. Their business may be in Europe and they're Canadian citizens. So there's no reason to bring that through the US back to Canada. We have a reinsurance company in Bermuda for a Colombian insurance company. So we set up a reinsurance company specifically for them. If they're doing punitive damage or something they can't write in the US, but for the majority of our clients, the tax benefits and the structure of a US captive is great for their business. So we have a lot of manufacturers, construction. So we have an office in Honolulu, LA, and New York. And the office in New York almost exclusively does home health care and construction, because that's a places where insurance premiums are high, and right now reinsurance rates are low. Staffing companies, so it's temp staffing, PEOs, mortgage brokers. I should add mortgage lenders to that. I think we have 3 of the top 5 mortgage lenders in the country have their own captive insurance companies. Law firms, accounting firms, really almost any industry you can think of, we probably have a clients in there. We have franchisees for restaurants. The largest private energy drink company in the world has their own captive, and that's an area where they're getting hit with claims. People have been up for playing video games for 48 straight hours on nothing but energy drinks, and then they have some sort of aneurysm or something, and so the company's always getting sued for that. Now, their product recall was millions of dollars a year, but actually they had very little recalls. So they said, why are we paying all of this money for something where the chance of risk is actually very small? So that's one area where we're very helpful with them.
So Wes, you might touch on this.
Yep.
Yeah, I think this is probably a slide you're going to do it, but I'm thinking people on the call might want to wonder, okay, at what point is a captive appropriate for me? Am I too small for a captive? What's the right sweet spot to even think about it?
Yeah. So if you ask me who's in the bullseye, you're a business owner and you're paying $1 million a year for workers' comp, health insurance, general liability insurance, and you have low claims, then you're right there. For medical insurance, if you have 100 employees or more, I would say you're right in the bullseye. Now, we do have clients where they're paying 400, but their claims are very low on that 400, and they have a lot of stuff that they didn't choose to buy insurance for. And then we have clients, widening that bullseye, who they may only have a guy yesterday. He has $35,000 in premium. I'm like, well, your premium's too low for a captive. But then we got digging. He has 8 pharmacies. He had 30 employees, but he just believes insurance is a scam. So he's chosen not to buy any. So he just had the mandatory stuff he needed. He had workers' comp, and he gave them a stipend for their medical insurance. And that was it. He owned the buildings. He didn't have any commercial property because he owned them outright. He's like, why would I pay? So once we started adding in all this other stuff, administrative actions is huge. As owning a pharmacy, if the FDA could come in and say you billed improperly, or you gave out a prescription for something that you shouldn't have given. You substituted a generic for a brand name or vice versa, and a person got sick or whatever. So administrative actions happen all the time. He's like, yeah, but I run a clean shop, so I don't have to worry about that. But that's something he could buy the insurance for on his own. So I would say it's really an analysis to see what is the risk in your business. And I guarantee you, as a business owner, if I ask like him, I'm like, hey, why don't you buy insurance? It's a scam. I'm not going to get into trouble. But you said, what are 10 things that keep you up at night as a business owner? And he and his wife very quickly rattled off 10 things that they worry about, that they could get sued on, or they could lose money on, or, they're in Connecticut and they're worried about, what if a superstorm Sandy comes in, because, they lost a couple $100,000 in property inside of their stores and drugged, because when Superstorm Sandy came through, it ruined one of the 8 stores. And it's all stuff like that. So it's really just sitting there thinking about things that could cause damage and cause you money. Does that make sense, Mike?
Yep. Thank you.
So case studies, we'll go through these pretty quickly. So this is a food distributor. They import a lot of stuff from China. They also export stuff, but they make processed meats. They make your pepperonis. Bologna. They make a lot of stuff. So before they became a client, they actually had 2 clients, or they had 2 captives. And this was back in the 831B at 1.2. They were each paying $1.2 million. Remember, I said that it was duplicate coverage. The business bought 2 policies, one from one captive, one for the other, for the exact same coverage. It wasn't a quota share where one paid half and the other paid half. They both were paying the same amount of premium. And because of the IRS regulations, I should have said earlier that the captives were put on what the IRS every year has, what's called the Dirty Dozen list. So it's their 12 biggest tax scams that they're looking for. And captive insurance was put on it in 2016, but it was removed earlier this year from their Dirty Dozen, because they said that the captive industry, there are still some abuses out there, but the captive industry has done a good job of cleaning itself up. I'd say they're a third the amount of captive managers today as there was back in 2015, because a lot of them have just left the business. We're lucky. We've been in this business since 2002, and strictly just managing captives since 2004. So we've seen a lot of good stuff come and go. But what their advisor told them is, because if they put their captives on an Indian reservation, it was a sovereign nation territory, so they didn't have to pay any taxes, and they didn't have to follow any of the government rules. Big mistake. So once we got them as clients, now there's 2 owners. They have 1 captive at $1.72 million. It's domestic instead of an Indian reservation. We looked at all their existing policies and wrote the following coverages. So this could give you a good, place to think. So we wrote administrative errors and omissions. They have a full-time U.S. Department of Agriculture person in their facility. Business interruption. They're actually submitting a COVID-related business interruption claim as we speak. Commercial crime, commercial property difference in conditions. We actually helped them restructure their existing commercial property policy. And then we covered a lot of the stuff that was still excluded from it. Contractual liability. If they have to provide, they do a lot of meat to Walmart. So if they have to provide 1 million pounds of tri-tip and they can't get that, then they still have to fulfill their contract. So this allows them to go out. They can buy it from other people and then sell it to Walmart to satisfy their contract. And that would pay the delta between what they had to buy it for and what they sold it for. Cyber liability, very small, but they did have it. Directors, officers, earthquake. They had 2 city blocks in downtown Los Angeles, well, right outside. And they had no earthquake insurance because they're like, it's just way too expensive. They have freezers, they have meat, they have all this stuff. If they had an earthquake, they would lose. I would guess at any one period of time, there's $300 to $400 million in product that's in their facility that could get ruined. General liability, different condition, ocean marine, product liability, product recall. Product recall is big. The government comes in and says, well, you have to recall all of this, and what are they going to say? No, they have to. So it not only covers the cost of recalling their product, but also to hire public relations firms in order to keep their reputation up, because reputational liability is one of the biggest things you have. Supply chain interruption. My office looks out on the port of Los Angeles and Long Beach, and I can see boats sitting there. We had a client, they do peaches. They bring in peaches from South America, they can them and jar them. I guess they jar them. And then, Mike, do you guys have Trader Joe's out there?
Yeah.
Okay.
A few.
So they do all of the peaches for Trader Joe's, but also they do all of the olive oil for Trader Joe's. So they bring in their stuff, it's stuck in the port because of COVID, and what happens? All the stuff rots. So then they have to go out and they have to buy more. So that's under their supply chain interruption policy. And then trade credit. If business goes bankrupt and your product is there, you're waiting for a bankruptcy court to give it back to you. And if it's something that's perishable, you'll never get that money. So trade credit covers people that don't pay their bills to you. It's accounts receivable risk, and it's widely used. We have a lot of clients that have it, and they submit a lot of claims on it. So in 14 months, they have $2.9 million in their captive and $176,000 in incurred claims. This is a medical stop loss. So our client has 165 cell phone stores, and their insurance premium, we had a captive for them for years. And in their insurance premium, their medical insurance kept creeping up. They're like, oh, finally they got to the point where they're like, is there something we can do? So this allowed them to lower their cost, increase the benefit, and added millions of dollars in company value. They're an ESOP company. So it's huge. Every dollar they save goes to the people who own the business. So in 2012, 13, 14, 15, you can see there, this yellow line is what they were paying. So they came to 2016 and it kept going up. So suddenly it's $800 per employee per month. So they came to us and they're like, we can't do this. When it was 300, fine. When it was 500, fine, but $800 per employee per month is huge. And that far surpassed what the red line is, which is medical inflation. So we took them over in 2016 at the 16-17 renewal, and you can see that's the actual real effects of this. So 2016, they paid $2.7 million. The cost, their renewal estimate was like 3.3, that their broker negotiated down to 3 million. So they're like, we can't do this. $3 million is huge. So what we did is we came in, we designed a group medical inside of their captive, and we used reference-based pricing. Don't have the time to go through it right now, but it is the key to maintaining high quality and keeping your costs down. So we bought stop loss, and that stop loss was $306,000. And they paid the first $100,000 per claim up to $1.833 million. Their actual paid claims came in at $619,000. So the total cost for the 2017 year, it was 2.7, was going to renew for $3 million, but their total cost came in at 1.183. Huge savings. Now, 2018 came in at 1.4, almost 1.5. 2019 was almost $1.1 million. But when we saved them all this money, we went back to them and said, hey, this, we think you should make your plan better. And they're like, okay, well, what can we do? So we recommended them get rid of co-pays for all generic medication and any maintenance medication. They did that. And then we said, well, why don't you get rid of the co-pays when they go to the doctors? They're like, we can never do that. We'll lose a ton of money. That could bankrupt us. Like, take a guess how much money that was in co-pays. And they said, I don't know, $200,000, $100,000. I said it was $8,700. $8,700 is all your employees spent on their $25 copays. And once we got rid of the copays for the prescription drugs, they're like, really, that's it? Boom. So now their employees have no copays on their medication and no copays when they go to the doctors. Huge.
So, tell me, Wes, what the difference would be there between just I mean, if somebody already has a self-funded life insurance plan, why would they set up a captive? They're already doing this part, it looks like.
Well, self-funded medical plan.
Yeah.
Yeah. One thing is with medical, you only get, if they're self-funded, you only get a deduction for the actual claims you pay. So in their case, they would have gotten the deduction for the 1.183, 1.4, because that's the actual true expense. But the thing about medical, remember when I said one of the main goals with this is consistent cash flow. They want to control their cash flow. So what they did is they actually paid this maybe if I can go back up. See the red line where it says medical inflation rate benchmark? So what they did is they paid the $2.7 million, then they paid 2.8, then they paid 2.9, then they just kept increasing it every single year. So they actually with a captive, you can overpay to your captive. So then when they have fluctuations in their medical expenses and their premiums, then it doesn't hit their bottom line. Does that make sense?
Yeah.
You deduct it. Because the thing is with a self-employed, with an S Corp, when they saved $2 million over what they were going to do the year before, that $2 million to them is taxed. It's for brothers and cousins. It's taxable to them as income. And they're at the highest rate. I mean, they're well over, so they're at the 36% federal, and they're in California, so it's 13.3%. So they'd be paying 50% of that away for themselves. So it's just a way for them to accumulate it. And one key thing between self-insurance and this is self-insurance, when you're buying your stop loss, that's a retail product. When you're buying the same exact product inside of a captive, it's reinsurance, so it's a wholesale product. So there's probably a 30% savings between the two stop loss policies. Here are all the ones that have done it: Costco, Amazon, Whole Foods, Halliburton. Some of the biggest companies in the country have done it. Health insurance is going through a lot. I'd say 60% of our captives, and I know we're short on time, 60% of our captives at this point are health insurance and workers' comp related. So clients are putting those inside because they see these things going up and up and up every single year. Consumer-driven, employer-controlled plans are going to be the ones that prevail. So I will open it up for questions. We went through a lot of stuff.
I thought I saw.
Hi,
Was there
this
a
is
question?
Michelle. Yes, there was a question that came in on chat. And this is what it says. It's from one of our attendees. Mike, I'm assuming your company is doing all of the underwriting, claims, adjusting, and policy writing. What is your fee for these services?
Actually, that's a Wes question.
Yeah, so to do are you talking about the medical insurance? We use a third-party administrator to do all the claims, to process the claims, to tie into the stop loss companies, to do the medical billing, all of that stuff. And you pay a per employee per month charge on that. If we go back.
Oh, sorry, I took control, but I think you still can do that, Wes.
Yeah, I was just going to say if you go back here, it's not going. Oh, I was just, that one where here. All right, the admin fee. So that's $257,544 is what got paid to the third-party administrator, and that's just a flat per employee per month charge. Call it $21 to $25 per employee. And that's if you want Cobra, if you want, I mean, their HSA administration, flexible spending accounts, all of this stuff goes in there, and that determines how much you pay them.
So a follow up to that then real quick, Wes, is if you thought you might be interested in learning more about a captive, what are the next steps?
We would have a call, you, me, the client, to just talk through their business, their, the premiums they're paying, the losses that they've had, and then our actuaries would do an analysis. If you thought it made sense, then we would go to the next step.
So they're going to need to know what they're paying, but also claims history.
Yeah, correct. Because that's really the key thing. As a business owner, if you can remember the last time an insurance company paid you more money in claims than you paid them in premium, you're probably not a good prospect. If you paid $1 million in premium and they paid out $1.5 million, I say stay in the traditional insurance market. But quite often it's the opposite, where they spend $1.5 million and the insurance company's paid out $200,000. And we have a lot of clients where we go through their stuff and they've been paying insurance premiums for 20 years and they've never had any claims. So that.
Well, we're running up on the hour. Michelle, I didn't hear you say that there were any other questions. So I think we'll move towards wrapping it up here. I want to thank Wes for helping us out. Lots of good information there, man. I really enjoy listening to you talk about these captives.
Yeah,
And,
thank you.
I've got a couple more things on the screen. We may have a question. Let me look here. See if we got one last one. Oh, no, that's the one we answered. So that's good. The next webinar we have coming up is Friday, December 4th, kind of a year-end estate planning webinar that we're having, and it's being put on by Gooseman Law Firm. Nick Montague will be the speaker at that. That's 11 o'clock on Friday, December 4th. So if you're interested in that, I don't know, Michelle, if we have that up on our website yet or not. Probably will in the next few days if we don't. So you can go to that cfgiowa.com/events. A lot of the folks that got invitations to this will be getting an invite on that as well. So you might be looking for that in the mail. And, I just think this was a great topic today. We talked about some really large premium increases that we think we're going to see over the next year or so. I was just online looking the other day and found that under businessinsurance.com, they said that U.S. commercial insurance prices just in the third quarter were up at an annualized rate of over 18%. So I think this is a timely topic here.
Which is kind of I would say, not to interrupt you, but that's flawed logic, because most of the insurance renews July 1st and January 1st. So it's a very small piece that renewed in that third quarter.
So probably even going to see something.
Oh, when the insurance industry, when the carriers say that they will have to increase their premiums a minimum of 200% for 8 years in a row to make up for their losses, I tend to take them at their word. So I think, it's going to get a lot worse before it gets better.
Sure. And, a lot of uncertainty with the weather events and COVID-19 and all that as well. So, for those business owners, obviously we chose this topic because we thought that insurance is something that's really going to get a lot more attention in the next year or so for the reasons that Wes just talked about. And anything that you can do to manage costs. A lot of times we think about on the revenue side and how we can increase the top line, but Obviously, if you can lower your expenses, then that's the other thing that adds to profitability, which is what all business owners want, right? Is increased profitability. And that really goes down not just to your bottom line on profit and loss, but also in the value of a business too. So if you're curious, if you're thinking one of those owners that thinking about over the next few years, you might be looking at a transition, selling the business or looking at transitioning out. One of the things we have on our website at cfgiowa.com towards the bottom of the homepage is a thing called Pre-Score, a button you can push and take a little exam. Gives you an idea really how prepared you are for that initial or that final transition event. And I would encourage you to do that. If you have any questions for Wes or you want to make connections with him, I would suggest that you could give us a call at that 800 phone number on the screen, 800-827-5577, or you can reach out to me at mikem@cfgiowa.com. With that, we're a little over an hour, so I want to thank you again, Wes, and thank
Thank you.
everybody who's on the call here today, and everybody go out and have a great day.
You too. Thanks so much.
Thanks. Bye.
Bye-bye.